As we all know, one of the things that's going to be happening this year is another presidential election. I find that a lot of investors actually think that election years are bad for the market. So I wanted to share some data with you that actually might suggest otherwise. And if you're someone who's worried about the market this year, this might help alleviate those concerns. According to data compiled by Morningstar, if we look at all presidential election years since the S&P 500 index began back in 1928, the average return of the S&P 500 index during an election year is actually 11.28%. There have been a total of 23 elections since 1928, and the market has actually been positive in 19 out of those 23 election years. So 83% of those years have provided positive returns. Additionally, it might not matter all that much who's elected. When we have a Democrat in the White House and we elect another Democrat, the average rate of return in that election year is 11%. When we have a Democrat in the White House and we elect a Republican, the average return is 12.9%. So pretty close, but not that different with regards to who's elected. Right now, we just think there's a lot of stuff going on that might be more impactful to the markets than the election. We actually discussed some of those issues and the longer-term seasonal outlook for the market in our most recent podcast episode. So give a listen to that if you're interested in more information.